know.
We're going as soon as you see that button pop up.
All right, Chris.
Not yet. Okay.
As soon as she starts letting people in.
I don't know. It's kind of like the wizard behind the curtain.
Yeah.
Goes in.
Go ahead.
All right. So looks like we've still got some people here entering in, and I'll wait for everybody to come in. So while I kind of wait for everybody to get in here, Chris, did you, I know you had started on your trek across Colorado as you were hiking Colorado, and you had to cut short because one of your hiking buddy had some, I think, issues or whatever. Are you planning on getting back out there, or what's the plan on that?
Absolutely. It may end up taking me a couple more years to get it completed, but it just seems like every time I go, something happens.
Yeah, it's
called perseverance.
It is, and sometimes it just takes a little bit of luck to get that out. Because how many miles is that? 500 and
yeah, right at 485.
485 mile. And it's not flat walking. So anyhow, all right. Well, let's go everybody here. Welcome everybody to this week's edition of the Community Cafe. I'm Glenn Stockton, and we have Chris Toman with us this morning as well. Chris is with First Option Bank and Trust. And so we'll be talking today about how to use estate and tax planning strategies for your benefit. Chris, this is something you do, a lot. You're focused on this a lot as you work with your clients at the bank, obviously, estate planning side. And we always have our tax goggles on, and we're looking for how can we use these strategies to put clients in a better position to minimize the impact of taxes. Not only, in my world, that people are often focused on how do we minimize tax at death when we're passing it on to their beneficiaries. But I tell them we want to make sure that we're minimizing the impact of taxes during their lifetimes as well. And there's various strategies and things that can be done, and very simple ones oftentimes that people miss. Mm-hmm. So we're going to talk about some of these. Some of these we're going to jump in the weeds a little bit. So grab your cup of coffee, roll up your sleeves, we'll get in it. Chris, let's start with, what are some of the basic estate planning techniques? So we'll talk about at death first. So we'll move into ones we use at life. So ones that you.
It's interesting from our standpoint, because we serve in a fiduciary capacity and managing trusts. A lot of what we do is typical investment assets, your stocks, your bonds, money markets, etc. But we also manage a significant amount of other assets, real estate, mineral and gas rights, contracts, notes, promissory notes, debentures, business assets. So, there are, when we look at it, we're looking at more than just, the typical cost basis information and tax planning strategies that most financial advisors out there see. And so you and I have dealt with a lot of these, and you brought up the at death piece, and this probably fits back into your estate planning more than anything. And I actually kind of put some of these things together in a slide for us. But let's start with the simple one that everybody should know about, and that's the step-up basis at death. I think it's important for maybe for you to, expand on that a little bit, because people do death planning, and where we used to have individual trusts, now we have the joint trust, and how does that impact the step-up in basis? So maybe talk a little bit about that.
Yeah, so that's one that people don't necessarily fully understand, but they don't always need to. It's that they can mess it up, right? So if you buy, step up in basis just says this. I'll give an example. You buy an asset. Doesn't matter what the asset. I guess there's some things that does matter, but you buy an asset, and let's say you purchase it for $100,000. But it's increased to value to $500,000, right? So you've got $400,000 of capital gain in that investment. Your basis, your tax basis or cost basis is $100,000. if you go to sell that asset during your lifetime, you're going to realize that $400,000 gain. The gain's not realized until you sell it. At death, when you pass it on, those assets get a step up in basis, meaning your beneficiaries get whatever the basis is, the value of that asset is at death. So it's 500,000. So they have no capital gain. They receive it 500,000, so they receive it tax free. But if you were to sell that asset during your lifetime, you would realize that gain. And there's things we can do, and we're going to talk about some of those days of what we can do when you're faced with that situation. You need to sell an asset, but it's that gain, that step up gives us that step up to that new value. In this example, 500,000. So there is none, but that happens at death. Where I see people go wrong with this, they will do things thinking they're trying to come up with their own plan of how they're going to avoid probate or maybe avoid Medicaid spend down. So they decide, I know, I'll put my kid's name on the home. I'll either title it to them or I'll just put them on as a joint tenant, so they transfer the home. And now, because we gifted them in that situation, we just quit claim it or put their name on the title. They haven't purchased it from us. We've gifted to them. They acquire our original cost basis. So if it was $100,000, they got that. So when they go to sell it, they didn't get the step up basis because you gave it to them during your lifetime. And so that's one of the common areas I see people kind of mess that up. And when I see they put their kid's name on the home, and it's well intentioned, they're trying to avoid probate, or sometimes they'll just completely get it in the kids' names because they're worried about that they're going to go to nursing home and Medicaid's going to take it. And as you and I both know, there's far better ways to do that than just put the kids on. So step up in basis is one we want to be aware of when we go to sell assets, what that is, what the capital gain is going to be. So that's a basic one.
Well, along that line, if you have a husband and wife that come to you and you've got a terminal outlook for one, are there things that you do to recommend moving significant assets with significant gain, maybe to one spouse or the other? How do you handle that in a joint trust type situation?
Well, I mean, it's going to vary from individual circumstances because there's so many factors that come into play. Is this a first marriage? Is this a blended family? Do we have all these other factors also are going to direct how we structure that? But with portability that we have, I mean, we're for the vast majority of us, right? We do not have an estate tax problem. So it used to drive our planning, and you and I have been doing this long enough. We remember when that was the driver that drove people to do estate planning or how our estate plans were structured. But now we have, for a married couple, we're about $25 million in exclusion amount, meaning we don't pay any estate tax at the federal level. And here in Kansas and Missouri, we don't have any state estate tax. So estate tax is not the issue. And when a first spouse dies, we now have portability. So I think of it in terms of coupon, right? IRS is giving each of us under current law about a $12.5 million coupon. And so at the death of the first spouse, the second spouse, whatever amount of that coupon was not used is carried over or ported over to the second spouse. So generally, we don't need to be too concerned about that in the planning from a tax standpoint.
Right.
There can be some specific things with certain assets that, might, because of how they were titled, could potentially have issues, but generally that's not a problem.
Well, I was going more towards the step up in basis piece. If you have an asset that that you're going to need to sell, do you ever recommend transfer of that asset to a spouse with a terminal outlook so that you are able to get the step up in basis while the other spouse is still alive?
Yeah, that would be a great technique. I don't think I've ever had that actually come up, Chris, where we've needed to do that, but that would certainly be one that think of it. If we had an asset that had that game we want to do, because we get that step up basis at death. So yeah, it would be absolutely something we would have on the radar screen. But I don't know that that's been one that I, in my practice, have actually used, but it's a great way to get that. So if we do have a terminal spouse. So yeah, good point on that.
Two of the things I've been asked about probably most recently Number one is gold, because gold has done so well. Now everybody wants to know about gold. But the other one is real estate investing. And along the lines of the step up in basis piece, you've got the 1031 exchange capability with real estate investors. Why don't you elaborate a little bit on that?
The 1031 exchange, it's referring to section 1031 of the IRS code that allows us to take, exchange an investment property. So this is not your primary residence. So 1031 exchanges are predominantly, almost exclusively dealt with in the real estate world, but we sell an investment property, and when we sell it, we're taking that and we're rolling it over or exchanging this property for another piece of property. And we do that, claiming under section 1031. So whatever capital gains we had on the sale of this property, we don't pay it because we've just exchanged it for another one. And we kind of roll that other basis over into the other piece of property. So this is a common strategy that will be used when we have real estate properties to either avoid or delay, the capital gains taxes we have by using 1031 exchanges. And, there's you can use 1035 exchanges, for, investment, annuities and that type of thing, 1031 exchanges for property. So it is a capital gains tax avoidance, or in some cases, completely eliminating those capital gains. So we hold the properties till death and get step ups, et cetera.
True. You and I've had the opportunity to work a couple times recently on section 453 irrevocable trust, which again ties back into that 1031 exchange idea, except instead of selling or transferring from one piece of property to another, you transfer the property to the irrevocable trust. The irrevocable trust is able to sell that property and push that capital gains implication out over the next 30 years using promissory notes. And it's actually a relatively simple idea, but it becomes very complicated in how the trust is drawn up in the tax code and how you execute that. And you have to use a third-party trustee. But to me, that's one of those exit points for moving away from real estate. I've got a guy right now that he's looking to sell roughly a $3 million portfolio of real estate, and he's going to transfer the entire portfolio into a section 453 trust, sell all of those pieces, and create an annuity stream for the rest of his life from the investment of those assets without having to pay the capital gains down.
Yeah, we kick the capital gains down the road and do the trust, and so it is one, if you're going to do that, and what I tell people is, if you have property that, you'd like to sell, but you're worried about there's going to be some capital gain, that's when you need to reach out to us or reach out to professional advisors, because this is one you're probably not going to pull this one off on your own if you don't have experience with this. You need to work with the attorneys or people like you, Chris, that can do this. And I would tell you, most financial professionals and even most attorneys, they're not dealing these things. They're just specialized areas. They're not all that complicated, but you do have to make sure that you dot your I's and cross your T's to stay in compliance with. And when we call it a 453 trust, again, because it's under section 453 of the IRS code, and so you just have to make sure you stay in compliance with code. But the concept is pretty simple. So why don't you kind of give an overview of that concept? What do we do? If we're going to do a 453, I'm the seller. I'm selling a piece of property to, Sam. What do I have to do before?
Okay, you are basically gifting that property to an irrevocable trust where you're the grantor. You are the income beneficiary during your lifetime. However, there's ultimately a full beneficiary at the conclusion of that. So that transfers, the trust actually sells that piece of property, not you. So you don't sell the property to Sam, the trust does. You've gifted the property to the trust sells the property to Sam. In exchange for you gifting that, you receive a promissory note from the trust. And I've always suggested pushing it out as far as possible because the trustee ultimately has discretion to pay it back early. So why would you not push that capital gains implication out as far as you possibly can? So you create a promissory note and set up a payment scheme from the trust to you as the grantor, where you're receiving on a monthly basis principal and interest from the sale of the piece of property that you just gifted to the trust. And the trust itself invests that money into stocks, bonds, other investment assets, creates a income stream from that piece of property, and now you're out of it. You're no longer managing real estate. You've created a pension benefit so that you can go sit on a beach. It's basically a self-created pension fund is really what it is for you.
And because you set out those capital gains, pushed them out over a long period of time, those dollars are now at work for you and generate. So it's a great way of generating cash flow that, we defer the capital gains.
Most real estate investors depreciate that asset significantly while they hold it. And so if they were to turn and sell that piece of property, let's say again, go back to your example, they bought it for $100,000, it's now worth $500,000. Let's say that they fully depreciated it, so they have no basis in it. If they were to sell it in their name, they're paying capital gains tax on that entire $500,000 gain. If they push it into the irrevocable trust, that $500,000 gain is realized over the next 30 years, with the majority of it coming late in the life of the promissory note, because it follows a typical amortization schedule.
And you and I have done several of those over the last couple of years here. And like you said, you've got one that you've got working now. So it's a great way. And so unlike a 1031, here we involve a trust. 1031 exchange, we didn't need to involve a trust. We just have to, make sure we've got that other piece of property. And there's time limits as to when you need to purchase that. So the 453, we're actually using a trust and creating cash flow on that. So another thing that came up, and Chris, you're the one who brought this to my attention, and it was something that was hidden away in our last tax bill that was handed down in 2018. We had tax reform coming out, and that was opportunity zones. Which is a fantastic way. Again, typically this is a real estate type investment, but talk to us about opportunity zones and how people can use those for tax planning purposes.
Well, it's interesting. When President Trump, won the election, you immediately started to look and see how he was going to benefit real estate investors. He is a real estate investor. And this is one of the things that surfaced out of all of the legislation that's been passed or recommended by his administration, was to create opportunity zones. And the concept was simple. Let's identify areas of the country that need investment dollars to come into it. Let's create a tax benefit for anybody willing to invest in them. And so as an example, locally here, we have Osawatomie, which is in an opportunity zone fund. So if you were to go invest dollars in there, there are certain tax benefits that are available to you. Primarily, let's go back to the gain that you're talking about. Let's assume that you sold that $500,000 piece of property with no cost basis. So you had a $500,000 capital gain that you were sitting on, with the potential to have to pay that tax in your 2020 taxes. So it would be due in April of 2021. If things are actually ever due again on April 15th, who knows if that'll happen. If you invested that money in an opportunity zone investment, that tax gets deferred, much like the 1031 exchange idea. And if you held that investment for 10 years, you get a step up in basis at 5 years, 7 years, and 10 years. And if you hold the investment for 10 years, the capital gains on both the gain that you make on the investment as well as the previous capital gain, they disappear. They go away. And so it actually creates an opportunity for you to not just defer taxes like we do with the 1031 and the Section 453, but you can actually eliminate that tax burden if you invest in an area of the country that that was designated as needing investment property. So it becomes risky for me to go buy property in Osawatomie or to buy property in someplace else that was designated an opportunity zone. However, there are big funds out there that created opportunity zone funds. Scaramucci is probably the most famous person, who was President Trump's communications director for about 10 minutes. But he created an opportunity zone fund and has done extremely well with it, and has made a lot of money for people, with the idea being that they would create big real estate deals in places that were opportunity zone funds. I mean, opportunity zone designate. And it's interesting because when you take a look at the maps, and the fund that I deal with actually has overlays and maps where you can see what investment properties are in what areas. Very interesting to look at. But all of a sudden you see Scottsdale, Arizona, Beverly Hills, California, Miami Beach, Florida, all have this opportunity zone fund component. So it wasn't just the Osawatomies of the world that became designated. San Francisco, California has significant areas of opportunity zone funds. So these larger funds were able to go and create investment opportunities in those places that you and I as individuals would not be able to do.
So it was really designed to get investment dollars coming into low economic areas of the
areas,
and to bring in development. So if somebody was going to invest in that, what type of investments can they purchase? Can they just purchase a piece of land? Is it a home? Is it rental? What do they have to do?
Well, no, it can't. The home and the land piece are out. It has to be an economic development project. Osawatomie was actually working on a solar farm project to provide power for the city of Osawatomie, and that was one of the things that an investor who wanted to use the opportunity zone tax benefits actually proposed doing. Some of the investments that the funds that I've used have done are the large car elevators in San Francisco, that, the parking elevators. They've built several of those. They invested in a low-income housing designated place in Scottsdale, Arizona. So there are some interesting things that they've done, and they're investing, hundreds of millions of dollars in these projects. So
you don't have to, as somebody who's facing a capital gain, I just sold a piece of property, I've got a capital gain. You don't have to be the one that goes out and says, I'm going to go purchase this and do it. You can invest that money then into one of these funds.
It's basically a hedge fund or a private equity fund. Yes.
Yeah. So you have the option.
Investment trust is really what it is.
Right. So again, as one of those opportunities that can make a huge difference is you've got a $500,000 asset that you just sold that you're going to be facing taxes on in this. And if you hold that investment for 10 years, you can hopefully get the gain in the investment, but can completely eliminate those. And at 5 years is when you start reducing. And once you're in for 5 years,
your basis actually steps up. I think it steps up 10% at 5 years, 15% at 15 years, and then 100% at 10 years.
In 10 years.
As an example, I had somebody that had sold a piece of property and was sitting, they had fully depreciated it. They were sitting on $1 million capital gain that they were going to have to pay in 2020. It was from a 2019 sale. And they invested $1 million in an opportunity zone fund. And so at the very least, they defer that tax burden out into the future. At best, they not only eliminate the capital gain that they had on the original $1 million, but anything that they make on the investment in the opportunity zone fund is tax-free as well.
Yeah. So it's just, one of those, I don't know how long this will be around for, but it's certainly something that's available
They
to us.
extended it until December 31st, 2020 because of COVID. It was supposed to end on December 31st, 2019. They extended it 6 months to June. And then when COVID happened, they extended it to December of 2020.
And it seems like, and who knows where things go, currently we have a sunset provision on it, but, it does seem like one of those things in the tax code that you could see being extended, it made permanently, because it's one that I think both parties can kind of agree on, that we need to get investment dollars into these areas. So, we'll know, but it's certainly something that goes now. All right. So we've talked about step up in bases, 1031 exchanges, 453 deferred sales trusts. We've talked about some opportunity zones. We'll get into now what, Chris, you had termed acronym soup, where there's several.
And we're running out of time. So let's just spend a few minutes on each one of these and kind of just maybe give a little bit of a definition and how it could be used.
All right, I'm going to throw the first one at you. Net unrealized appreciation, NUAs. Okay. Tell us about an NUA.
If somebody has a 401k or an 401k probably from an employer, and they had company stock invested in their 401k that had done extremely well. Let's say over the course of their time at XYZ company, they invested hundreds of thousands of dollars in their 401k in their company stock, and it's now worth several $1 million. Okay. So, go back to the required minimum distribution discussion we had before. As you took that out, that becomes fully taxable. Using the net unrealized appreciation rules, you can actually remove that asset from the 401k or from the IRA that you roll it into and move it out at cost basis. And so you only pay the taxes on the difference between what you paid for it and what it's worth today. And it becomes a capital gains issue as opposed to an income tax issue. So net unrealized appreciation, even though it still puts you in a taxable position, can save you tremendous dollars on taxes. Instead of being taxed at income tax rates, you're now being taxed at capital gains tax rates. Instead of being taxed on the entire amount, you're now being taxed on only the gains that you've had in that position. It's a tremendous, it could save you hundreds and hundreds of thousands of dollars in taxes.
Yeah, if we're going in, I mean, we'd certainly rather pay the capital gains rate than what we're going to pay on ordinary income. So it's one of those, again, that can be, if you do it right, you can reduce the cost of the tax rate that you're going to pay. All right, next.
You bite that bullet all up front, but it's a much smaller bullet than it would be to bite it at income tax rates.
All right, next acronym out of our acronym soup is QCDs. So talk to us about QCDs.
You're in charge of QCD.
All right. So qualified charitable distributions. This is a way, and this really comes into play for those who are now already taking required minimum distributions from their retirement plan. So they either turned 70 and a half before January 1 of this year and had to start taking them, or they're now at 72. But if you're taking your required minimum distributions from your IRAs or 401ks, your qualified retirement plans, and you're a person who is, giving charitably, you're tithing to your church, you're giving to, different charities on, once a year, monthly, weekly basis, however you do that, and you're just writing that check, you're missing an opportunity. Because what you can do is you can have that money go to the charity, and I'll use people who, tithe with their church as an example. So instead of each week you writing that check and put it in the offering plate at the church, you can have that money go directly, tell your plan administrator, I want that money coming from my IRA. It can mail it to you, right? It's going to be made out to the charity, to the church or charity that you're giving to. It's made out payable to them, but they can send it to your mailbox, so you can drop it in the offering plate if you wish, or give it to the charity directly. But because it came from the IRA directly made out to the charity, it is a charitable distribution, so it does not count as income to you. So you're not taxed on that money. Whereas if you had just taken the withdrawal, your required minimum distribution or X other money out of your IRA and then wrote the check, you no longer get the charitable deduction, right? That was eliminated with the tax code. and you had to pay taxes. But by having it go pay directly to the charity from the IRA, it's not taxable to you. It's not taxable to charity because they're a tax exempt organization. So in essence, we're stacking on top of our standard deduction or deduction that we have. We're stacking this charitable distribution because we didn't pay taxes on it, and it goes towards satisfying your required minimum distribution. So it counts against the RMD. So you've got less money that you're forced to take out and pay taxes on. So it's one of those ones that I see people often miss. I think a lot of accountants miss this because, in my experience, most of the CPAs and accountants, they're great historians, right? They track what you've done. They're not necessarily really good at telling you, no, this is what you should be doing. So it's just a way to kind of stack on top of your charitable, stack on top of your standard deduction. Right. All right, next acronym, ILETS.
I'm going to hit on this one because this one's kind of near and dear to my heart. You mentioned that you and I are old enough to look back on when we were actually doing estate planning to avoid the estate tax. And in about 2003, 2004, we started to see a shift where beneficiaries began, sisters were suing brothers, kids were suing their parents. That sense of entitlement for these assets became, it was the number of lawsuits, interfamily lawsuits and squabbles that I've seen since 2003. It's mind blowing to me. Prior to that, we just kind of accepted the fact that you tell me what to do with that IRA and that's the way that it is. Now I look at that and say, well, I should be entitled to be a beneficiary of your IRA. Therefore, I'm going to sue you because you obviously overlooked me by accident. So go back to the irrevocable life insurance trust. We used to move that so that it became so that it was not counted for the estate tax.
Right. Removed it outside.
Because of all of the lawsuits, I still think that this is an extremely powerful tool because you're able to set aside those life insurance benefits into a separate vehicle that you can have a third-party trustee control that beneficiary's distributions. Make sure that my drug addict son doesn't end up with $500,000 to be able to, get to go do what he wants to do. Or my spendthrift daughter doesn't travel around the world for 2 years on, with the life insurance proceeds that I spent a lifetime building. I think having that to create structure will actually help that next generation. So to me, it's a very important tool.
Right. So it's really protecting minors and our kids and grandkids and that type of thing. So, well, Chris, we are out of time as we go here. We could go on there. We've got plenty of things to do there. I would just tell people, when we're doing this, we need to constantly have your tax goggles on. There are opportunities out there and things can be used to help minimize and manage the taxes. We're never going to probably eliminate taxes completely. For most of us, but we certainly want to minimize it. I would just encourage you, work with professionals who understand taxes and who are able to look at your situation and kind of guide you through this and help you find ways to minimize that impact. So, Chris, any parting words you have for everybody as we wrap up here?
As always, just miss Mark.
All right. So we will, I don't know if Mark's coming in next week or whatever. I should know what the
remember either.
I don't remember. So it'll be, we'll tune in, guys, everybody, next week. Hope this was useful. I find it fascinating when we start talking about it. So, Chris, thank you very much. Have a great rest of your day.
Good to see you.
All right. Good to see you, Chris. Bye-bye.
Bye-bye.